I need to tell you something that almost nobody on Wall Street wants to hear. Something that could determine whether you retire comfortably or spend your golden years wondering what went wrong. The Federal Reserve is about to make a catastrophic mistake. And if you do not understand what is happening right now, if you do not position yourself correctly before this unfolds, you could lose a significant portion of everything you have worked your entire life to build. Let me be very clear about who I am and why you should listen to me. I am Michael Burry. I founded Sign Capital in 2000 with nothing but a small inheritance, some loans from my family, and an obsessive dedication to understanding financial markets that most people considered unhealthy. I was a medical doctor who never finished his residency because I could not stop analyzing stocks during my night shifts at Stanford Hospital. I would stay up until 3 or 4 in the morning reading annual reports, studying balance sheets, trying to understand why certain companies succeeded while others failed. Most people thought I was crazy. They still do. I lost my left eye to cancer when I was 2 years old. I have Asperger's syndrome, which makes me see the world differently than most people. I do not process social cues the way others do. I do not care about fitting in or being popular. I care about one thing and one thing only, the truth. And the truth right now is terrifying. In 2005, I saw something that everyone else was missing. I spent months, years actually, reading through thousands of individual mortgage loan documents. Not summaries, not reports from analysts, the actual documents. Page after page of mortgages being issued to people who had no business borrowing that kind of money. Adjustable rate mortgages with teaser rates that would reset to levels borrowers could never afford. No documentation loans where people were not even required to prove they had income. Interest-only mortgages where borrowers were not paying down any principal. Everyone on Wall Street looked at these mortgage bonds and saw safety. AAA ratings from the agencies. Strong housing prices. Decades of history showing that Americans always paid their mortgages. But I saw something different. I saw a house of cards built on the assumption that housing prices would never decline. And I knew, with absolute certainty, that assumption was wrong. So I made a bet that everyone thought was insane. I bought credit default swaps against subprime mortgage bonds. Essentially, I was paying insurance premiums betting that these bonds would fail. My investors thought I had lost my mind. They demanded their money back. They threatened to sue me. They sent me angry letters, calling me every name you can imagine. For 2 years, I watched my fund lose money while I waited for reality to catch up with the fantasy everyone else was living. 2 years of paying premiums. 2 years of investors screaming at me. 2 years of everyone telling me I was wrong. Then in 2007, reality arrived. The subprime mortgage market collapsed exactly as I predicted. My fund made over $700 million for investors. I personally made $100 million. And the entire global financial system nearly collapsed. I am telling you this story not to brag. I am telling you because I see the same patterns forming again. Different circumstances, yes. Different triggers, certainly. But the same fundamental dynamic. A financial system that has convinced itself that certain risks do not exist. A Federal Reserve that is trapped by its own policies. And valuations that only make sense if nothing ever goes wrong. Let me explain what I am seeing right now and why it keeps me up at night. The Federal Reserve is caught in what I call an endless loop. They have created a situation where they cannot raise rates without crashing the economy, and they cannot lower rates without reigniting inflation. Every choice they make creates new problems. Every solution becomes the next crisis. And right now, as we speak, they are being forced toward a decision that could trigger the most severe market correction since 2008. Here is the core problem. Since the financial crisis, the Federal Reserve has kept interest rates artificially low for far too long. They flooded the system with money through quantitative easing. They bought trillions of dollars in bonds. They convinced investors that there was a Federal Reserve put protecting them from any serious losses. And in doing so, they created the largest asset bubble in history. Look at the numbers. The Shiller price-to-earnings ratio, which measures stock valuations against 10 years of inflation-adjusted earnings, currently sits around 39. The historical average is about 17. The only times this ratio has been higher were in 1929, right before the Great Depression, and in 1999, right before the dot-com crash. Both of those periods were followed by devastating market declines. The Buffett indicator, which measures total stock market value relative to GDP, shows the market at approximately 230% of GDP. Warren Buffett himself called this the best single measure of where valuations stand. The historical average is around 80%. We are nearly 3 times that level. This is not normal. This is not sustainable. This is a bubble waiting to burst. Now, here is where the Federal Reserve's trap becomes clear. Inflation is running above their 2% target. Consumer prices continue to climb. Tariffs and trade policies are adding upward pressure to prices. The Federal Reserve should be raising rates to combat inflation. That is their mandate. That is what their own economic models tell them to do. But they cannot raise rates, not really, not significantly. Because if they do, several catastrophic things happen simultaneously. First, the housing market collapses. Home prices have been supported by low interest rates for over a decade. When mortgage rates rose from 3% to 7% in 2022, the housing market froze. Transactions dropped dramatically. Prices started falling in many markets. Homeowners who bought at the peak found themselves underwater. If the Federal Reserve raises rates further, this becomes exponentially worse. Millions of homeowners who locked in low rates would be trapped in their homes, unable to sell because they cannot afford to buy something else at higher rates. The housing market would seize up completely. Second, corporate America implodes. Companies have been borrowing at record low rates for years. They took on enormous amounts of debt because the cost of servicing that debt was so cheap. But much of that debt needs to be refinanced in the coming years. If rates are significantly higher, companies that looked healthy suddenly cannot afford their interest payments. Defaults spike. Bankruptcies follow. The corporate bond market, which is over $10 trillion, faces a crisis. Third, the banking system comes under severe stress. Banks hold massive portfolios of bonds and loans. When interest rates rise, the value of existing bonds falls. We already saw this with Silicon Valley Bank and several other regional banks in 2023. They failed because rising rates caused their bond portfolios to collapse in value. Higher rates would put even more banks at risk. Fourth, the federal government's finances become unsustainable. The United States is running deficits of nearly $2 trillion per year. The national debt is over $34 trillion. Interest payments on that debt are already over $1 trillion annually, more than we spend on defense. If rates go higher, those interest payments explode. The government has to borrow more to pay the interest on what it already owes. This creates a debt spiral that becomes impossible to escape. So the Federal Reserve is trapped. They need to raise rates to fight inflation. But if they raise rates too much, they crash the economy. They crash the housing market. They crash corporate America. They crash the banking system. They crash the federal budget. Everything breaks. And here is what really scares me. The Federal Reserve knows they are trapped. They have been trying to thread an impossible needle, raise rates enough to slow inflation, but not so much that they cause a recession. Engineer what economists call a soft landing, where the economy slows just enough to reduce inflation without causing serious damage. But soft landings are extraordinarily rare. I have studied monetary policy going back over 100 years. Almost every significant tightening cycle by the Federal Reserve has ended in recession. The one exception was the mid-1990s, and even that required a combination of circumstances that are not present today. What makes this cycle particularly dangerous is the level of debt throughout the system. In previous cycles, the economy had more cushion. Consumers had less debt. Corporations had less debt. The government had less debt. Today, everyone is leveraged. There is no room for error. Let me tell you a story that shaped how I think about Federal Reserve policy mistakes. In the late 1970s, America was suffering from something economists call stagflation. Inflation was raging, reaching double digits. Unemployment was high. Economic growth was stagnant. The Federal Reserve, under chairman after chairman, tried to fight inflation through modest rate increases. But every time unemployment started rising, they backed off. They were afraid of causing too much pain. So inflation never really got under control. It kept coming back, worse each time. Then Paul Volcker became Federal Reserve Chairman in 1979. Volcker understood something his predecessors did not. Half measures would not work. The only way to kill inflation was to shock the system. To raise rates so high that the economy would go into recession, but inflation expectations would be permanently broken. Volcker raised the federal funds rate to 20%. 20%. Think about that. Your mortgage rate today might be 7%, and people complain about it. Volcker pushed rates to 20%. The result was brutal. Unemployment soared to nearly 11%. Farmers drove their tractors to Federal Reserve headquarters in protest. Car dealers mailed Volcker coffins containing the keys to unsold cars. He was the most hated man in America. But it worked. Inflation, which had been at 13%, fell to 3% by 1983. And for the next 40 years, inflation was not a serious problem. Volcker's painful medicine cured the disease. Here is what worries me about the current Federal Reserve. They do not have Volcker's courage. They are terrified of causing a recession. They are terrified of unemployment rising. They are terrified of being blamed for economic pain. So they try to split the difference. They raise rates, but not enough. They fight inflation, but not decisively. And in doing so, they risk the worst possible outcome. An economy that stays weak, but inflation that stays elevated. Stagflation, like the 1970s. The current situation is complicated further by factors that did not exist in Volcker's era. The government is running massive deficits. The debt is astronomical. The banking system is fragile. The global economy is interconnected in ways that create contagion risk. And there are political pressures on the Federal Reserve that make it harder for them to do what is necessary. But here is what I really want you to understand. The Federal Reserve will eventually be forced to make a choice. They can either let inflation run, which destroys the purchasing power of everyone's savings and creates social unrest, or they can raise rates aggressively to kill inflation, which crashes asset prices and causes recession. There is no good option. Only bad options and worse options. I believe the Federal Reserve will eventually be forced to raise rates more than markets expect, not because they want to, but because inflation will prove more persistent than they hoped, and they will have no choice. When that happens, the asset bubble that has been building for over a decade will finally burst. Let me explain what happens when an asset bubble of this magnitude bursts, because most people have never experienced it. Most investors today came of age during one of the longest bull markets in history. They have never seen a true bear market that lasts for years. They have never watched their portfolio lose 50 or 60 or 70% of its value and stay down for a decade. In the year 2000, after the dot-com bubble burst, the Nasdaq lost nearly 80% of its value. It took 15 years to recover to its previous highs. 15 years. If you were 50 years old in 2000 and your retirement was in technology stocks, you were 65 before you got back to even. That is assuming you did not panic and sell at the bottom, which most people did. In 2008, when the housing bubble burst and the financial crisis hit, the S&P 500 lost over 50% in about 18 months. Major financial institutions failed. Bear Stearns, Lehman Brothers, Washington Mutual, AIG required a $185 billion government bailout. Millions of people lost their homes. Millions more lost their jobs. Retirement accounts were decimated. The pattern is always the same. Asset prices rise to unsustainable levels. Everyone convinces themselves it is different this time. There is always a narrative explaining why traditional valuation metrics no longer apply. In the late 1990s, it was the new economy. In 2007, it was housing prices never fall nationally. Today, it is artificial intelligence will change everything. I want to be clear about something. I am not saying artificial intelligence is not transformative. It probably is. I am not saying these companies are bad businesses. Many of them are extraordinary businesses. But even extraordinary businesses can be terrible investments if you pay too much for them. And right now, prices assume perfection. Prices assume nothing goes wrong. Prices assume growth continues at current rates forever. When I shorted the housing market in 2005, it was not because I thought housing was fundamentally bad. Housing is a basic human need. It was because prices had reached levels that could only be justified if conditions that had never existed in history somehow persisted forever. That is the same situation we face today with many asset classes. Now, let me tell you specifically what I think could trigger the crash. The most likely scenario is that inflation proves more persistent than the Federal Reserve expects. Tariffs continue to put upward pressure on prices. Wage growth remains elevated. Supply chains remain disrupted. The Federal Reserve, faced with inflation that refuses to come down, is forced to raise rates further than they planned. Initially, markets might not react badly. They might even rally on hopes that higher rates will quickly bring inflation under control. But as rates stay elevated, the stress starts showing up. First, in the most leveraged parts of the economy. Commercial real estate, which is already in crisis. Regional banks with heavy exposure to commercial real estate, highly leveraged corporations that cannot refinance their debt. Then it spreads. Consumer spending weakens as higher rates increase mortgage payments and credit card costs. Corporate earnings decline as consumers pull back. Stock prices start falling as earnings disappoint. This triggers margin calls for investors who have borrowed to buy stocks. They are forced to sell, which pushes prices lower. More margin calls, more forced selling. A negative feedback loop. At some point, something breaks. It could be a major bank. It could be a sovereign debt crisis in Europe or Japan. It could be a hedge fund that has made enormous leveraged bets that go wrong. It could be something nobody is even watching right now. In 2008, it was Lehman Brothers. Nobody expected that to be the trigger. But once it happened, the entire system nearly collapsed. When something breaks, panic sets in. Investors rush for the exits, liquidity disappears. Assets that seemed liquid become impossible to sell at any price. The Federal Reserve is forced to cut rates and restart quantitative easing. But by then, the damage is done. Asset prices have collapsed. Wealth has been destroyed. And the Federal Reserve's credibility is permanently damaged because everyone realizes they created the bubble they are now trying to clean up. This is the scenario I am positioning for. Not because I want it to happen. I would much prefer a soft landing where everything works out fine. But because my analysis tells me the probabilities favor this outcome. And in investing, you have to be prepared for what is likely, not what is pleasant. Let me share something personal. In 2005 and 2006, when I was building my short position against subprime mortgages, I was miserable. Not because I doubted my analysis. I was certain I was right. I was miserable because I knew what was coming meant devastating losses for millions of ordinary people who had no idea what was about to hit them. People who had simply followed the advice of their real estate agents and mortgage brokers. People who trusted the system. People who would lose their homes and their life savings through no fault of their own. I feel the same way now. I see people pouring their retirement savings into the stock market at record high valuations. I see people buying houses they cannot really afford because they are afraid of being priced out forever. I see people taking on debt because interest rates, while higher than before, are still historically low. And I know many of these people are going to get hurt badly when this unravels. That is why I am speaking out. That is why I delete my tweets after I post them, because the regulatory attention is not worth it, but I keep posting anyway. Someone needs to warn people. Someone needs to explain what is happening, even if most people do not want to hear it. Now, let me tell you what I think you should do to protect yourself. Because understanding the problem is useless if you do not take action. First, assess your personal financial situation honestly. How much debt do you have? What are the interest rates? What happens if rates go higher? What happens if you lose your job in a recession? What happens if your portfolio loses 40 or 50% of its value? Can you still retire? Can you still pay your bills? Can you still feed your family? These are uncomfortable questions. Most people avoid them, but you need to answer them now while you still have time to adjust. Second, reduce your exposure to overvalued assets. I am not saying sell everything and go to cash. That is market timing, and market timing is extremely difficult. But if you have a portfolio that is 90% stocks at historically extreme valuations, you are taking enormous risk. Consider reducing your equity exposure. Move some assets to short-term treasury bills, which now yield nearly 5%. That is real return with virtually no risk. You do not need to be a hero. You do not need to catch every last dollar of upside. Preservation of capital should be your first priority. Third, avoid long-duration bonds. This is critical. Many people think bonds are safe. They think bonds protect you in a downturn. But long-duration bonds, 20-year treasuries, 30-year treasuries, these can lose 30 or 40% of their value if interest rates rise significantly. We saw this in 2022 when bonds had their worst year in history. If you need fixed income exposure, keep it short. 1-year to 3-year maturities. Treasury bills. Nothing that will get destroyed if rates move against you. Fourth, be extremely cautious about commercial real estate. Office buildings are in crisis because of work from home. Retail is struggling because of e-commerce. Even multifamily is showing stress in many markets because too much supply was built during the low-rate era. Many commercial real estate loans are held by regional banks. When those loans default, those banks face serious problems. The ripple effects will be widespread. Fifth, avoid highly leveraged companies. When the credit cycle turns, the most indebted companies are the first to fail. Look for companies with strong balance sheets, low debt, strong cash flow. These companies will survive the downturn and actually benefit because their weaker competitors will not survive. Quality matters more than ever when times get hard. Sixth, maintain significant cash reserves. Cash is optionality. When asset prices crash, cash allows you to buy at discounted prices. In 2009, at the depths of the financial crisis, incredible companies were available at once in a generation prices. But only investors with cash could take advantage. If you are fully invested when the crash comes, you have no ability to capitalize on the opportunity. Seventh, think globally. The United States is not the only market in the world. Many international markets are trading at far more reasonable valuations. Emerging markets, despite their risks, offer better long-term value than the overpriced U.S. market. Diversification across geographies provides some protection against a U.S.-specific crisis. Eighth, prepare mentally for volatility. This is perhaps the most important advice I can give. Even if you do everything right, even if you reduce risk and maintain cash and avoid overvalued assets, you are still going to experience paper losses. You are still going to watch your portfolio decline. You are still going to feel fear. The question is whether you will panic and sell at the bottom, locking in your losses, or whether you will maintain discipline and stick to your plan. The investors who survive and thrive through downturns are those who prepare mentally in advance. They know what is coming, they have a plan, and they execute the plan regardless of how they feel. Let me share another story from my experience. During the financial crisis, from late 2007 through early 2009, I watched as the world fell apart. Banks failed, markets crashed, people who had been millionaires became broke overnight. It was terrifying. And you know what I did? I bought. Not recklessly, not everything, but selectively. I bought great companies at prices that reflected the panic, not the reality. The investors who bought during the crisis made fortunes in the following decade. The investors who sold in panic destroyed their financial futures. This is how it always works. The time to buy is when there is blood in the streets. The time to sell is when everyone is euphoric. Right now, we are closer to euphoria than to blood in the streets. That should tell you something. I want to address the people who will say I am wrong. Who will say the market can stay elevated? Who will say valuations do not matter anymore? Who will say the Federal Reserve will never let the market crash? To the first point, yes, the market can stay elevated for longer than anyone expects. I was early on my housing bet by 2 years. Being early is the same as being wrong until you are eventually right. But the math does not change just because the reckoning is delayed. Eventually, valuations matter. Eventually, reality asserts itself. The question is not if, but when. To the second point, valuations always matter over long time horizons. There is over a century of data proving that buying at high valuations leads to poor long-term returns. The correlation is not perfect. Nothing in investing is perfect, but it is strong enough to be meaningful. When you buy at a Shiller PE of 39, history tells you that your returns over the next 10 years will be poor. Not necessarily negative, but well below average, and possibly negative if you add a crisis to the mix. To the third point, the Federal Reserve put. The idea that the Federal Reserve will always rescue markets. This is the most dangerous belief of all. Yes, the Federal Reserve has historically stepped in to support markets during crises, but their intervention has limits. In 2008, even with unprecedented Federal Reserve action, the market still fell over 50%. In 2000, even with rate cuts, the Nasdaq still fell 80%. The Federal Reserve cannot prevent recessions. They cannot prevent bear markets. They can only affect the timing and the depth. And sometimes, their previous interventions make the eventual reckoning even worse. The Federal Reserve has created moral hazard. They have trained investors to believe that risk does not matter because the Fed will always bail them out. This leads to excessive risk-taking, which creates larger bubbles, which require larger bailouts. It is a vicious cycle. And eventually, the bubble becomes so large that even the Federal Reserve cannot prevent it from bursting. I believe we are at or near that point. The bubble is so large, the debt is so enormous, the valuations are so extreme, that when this unravels, it will be unlike anything we have seen in our lifetimes. I could be wrong. I am wrong sometimes. I was wrong about Amazon being overvalued in 2000. It kept going up before eventually crashing. I was wrong about the timing of the housing crash. I was early by 2 years. But I was not wrong about the fundamentals. I was not wrong about the direction. The crash eventually came, exactly as I predicted. I do not think I am wrong now. The data is too compelling. The patterns are too clear. The risks are too obvious. Something is going to break. The only questions are when and what triggers it. So what am I doing personally? I have been reducing exposure to overvalued assets. I closed Cyan Asset Management recently because I cannot in good conscience manage other people's money when my view of the market is so different from consensus. My estimation of value is not in sync with the markets, and I do not want to fight that battle with other people's capital. I am focusing on areas I understand deeply: water rights, farmland, real assets that have value regardless of what the stock market does. I am also maintaining significant cash reserves so I can act when opportunities emerge. And I am warning people. Through tweets that I delete, through rare interviews, through whatever platform I have. Because I remember what it felt like in 2008 watching ordinary people lose everything. And I do not want that to happen again without at least trying to sound the alarm. Let me leave you with this thought. The greatest fortunes are not made during bull markets. Anyone can make money when everything is going up. The greatest fortunes are made by people who see crises coming, who preserve their capital through the downturn, and who have the courage to buy when everyone else is selling. In the year 2009, the best investors in the world were deploying capital aggressively. They were buying stocks that had fallen 70 or 80%. They were buying real estate at distressed prices. They were making investments that would return 5 times, 10 times, 20 times their money over the next decade. Those opportunities exist only if you have capital to deploy. Those opportunities exist only if you have not been destroyed by the crash. Those opportunities exist only if you have the mental fortitude to buy when the world is telling you to sell. That is the position I want you to be in. Not fully invested at the peak, not leveraged into a market that is historically overvalued, but prepared, patient, ready to act when the opportunity comes. The Federal Reserve rate hike that could crash the market may be coming soon, or it may be delayed, but it is coming. The math demands it. The cycles demand it. History demands it. Prepare now while you still can. Reduce risk. Build cash reserves. Strengthen your balance sheet. And wait. The opportunity of a generation is coming for those who are ready to seize it. I have been preparing for this moment for years. The question is, will you be ready when it arrives? History does not repeat exactly, but it rhymes. And right now, the rhyme I hear is the one that preceded every major crash of the past century. Extreme valuations, excessive optimism, complacency about risk, faith that this time is different. This time is never different. The details change, the triggers vary, but the outcome is always the same. Bubbles burst, prices revert to fundamentals, and those who ignored the warning signs pay the price. Do not be one of them. The warning signs are flashing. The Federal Reserve is trapped. The bubble is enormous, and the crash, when it comes, will be historic. I have told you what I see. I have told you what I think is coming. I have told you how to prepare. The rest is up to you. But remember, in investing as in life, the biggest risk is not taking any risk. It is not knowing what risks you are taking. Right now, most investors are taking enormous risks without even realizing it. They think they are safe because they own index funds or blue-chip stocks or bonds. They are not safe. No one is safe when valuations reach these levels. No one is safe when the Federal Reserve is trapped. No one is safe when the entire financial system is built on the assumption that nothing will ever go seriously wrong. Something will go wrong. Something always goes wrong. The question is whether you will be positioned to survive it, or whether you will be one of its victims. I choose to survive. I choose to prepare. I choose to see what is coming. Even when it is uncomfortable, even when people think I am crazy, even when the short-term evidence seems to contradict me. Because I have seen this movie before. I know how it ends, and I refuse to be surprised when the credits roll. The Fed rate hike that could crash the market is not a possibility. It is an inevitability. The only variable is timing. Position yourself accordingly. Your financial future depends on it. Now let me go deeper into something that most analysts are completely ignoring: the mechanics of how modern markets actually crash. Because understanding the mechanism helps you understand why the next crash could be faster and more severe than anything we have experienced before. In the old days, before algorithmic trading, before high-frequency trading, before passive investing became dominant, markets crashed in slow motion. You could see it happening. There was time to react. People would wake up, read the newspaper, call their broker, and place orders. The process took hours or days. Panic spread slowly. Today, everything happens in milliseconds. Over 70% of daily trading volume is generated by algorithms. These are computer programs that buy and sell based on mathematical models, not human judgment. When conditions change, when volatility spikes, when certain triggers are hit, these algorithms all react at once, in the same direction, at the same time. In March of 2020, we saw a preview of what this looks like. When COVID fears hit, markets crashed faster than they ever had before. The S&P 500 fell over 30% in just 23 trading days. That is the fastest decline of that magnitude in history. Why? Because algorithms were all selling simultaneously. There were no human circuit breakers, no time for reflection, just wave after wave of automated selling. Now imagine that happening when the underlying fundamentals are even weaker than they were in 2020. In 2020, the economy was healthy before COVID hit. Companies had been profitable. Balance sheets were reasonably strong. The crash was purely about pandemic fears, which turned out to be temporary. The next crash will be different. It will be about fundamentals, about valuations that cannot be justified, about debt that cannot be serviced, about a Federal Reserve that has lost control. And when that crash comes, the algorithms will make it worse, not better. They will amplify the selling. They will remove liquidity at exactly the wrong moment. They will turn a correction into a catastrophe. There is another factor that worries me deeply: the rise of passive investing. Over the past 20 years, there has been a massive shift from active management to passive index funds. Today, roughly half of all equity assets are in passive strategies. This sounds benign. Index funds have low fees. They outperform most active managers. What is not to like? The problem is that passive investing works great until it does not. When everyone is buying index funds, money flows into stocks regardless of valuation. It does not matter if a company is overpriced. If it is in the index funds buy it. This creates a self-reinforcing loop where prices go up because money flows in, and money flows in because prices go up. But what happens when that reverses? What happens when investors start redeeming from their index funds instead of adding to them? The same mechanism works in reverse. Index funds have to sell stocks to meet redemptions. This pushes prices down. Lower prices cause more investors to redeem. More redemptions force more selling. It becomes a death spiral. We have never experienced a true bear market in the age of passive investing dominance. The brief COVID crash in 2020 does not count because the Federal Reserve intervened immediately and flooded the system with money. The next crash might not be so easily fixed. If inflation is the problem, the Federal Reserve cannot just cut rates and print money. That would make inflation worse. They would have to sit on their hands while the market crashes, and that is something they have never had to do in the modern passive investing era. I want to tell you about something I learned the hard way. The difference between being right and being early. In investing, they are often treated as the same thing, but they are not. Being early can be just as painful as being wrong, sometimes more painful, because you have to endure the losses while waiting for reality to catch up with your analysis. When I started buying credit default swaps against subprime mortgages in May of 2005, I was certain I was right. My analysis was solid. The data was overwhelming. These mortgages were going to fail. The bonds backed by them were going to collapse. I had no doubt. But being right did not mean being profitable immediately. For 2 years, I paid premiums on those swaps. Every month, money flowed out of my fund. My portfolio showed losses. My investors saw their returns turning negative while the rest of the market was making money. The pressure was unbearable. Investors who had trusted me started questioning everything. They demanded explanations. They threatened to withdraw their capital. Some of them did withdraw, locking in their losses just before the trade finally paid off. I used a provision in my fund documents called a side pocket to prevent mass redemptions. Essentially, I froze their money so they could not take it out. This was legal, but it was not popular. People were furious. They accused me of stealing their money. They called me every name you can imagine. And then, in 2007, everything I predicted came true. The subprime market collapsed. My credit default swaps exploded in value. The fund made hundreds of millions of dollars. The same investors who had been threatening to sue me were suddenly my biggest fans. The lesson I learned was that conviction has a cost. If you see something that nobody else sees, if you position for an outcome that everyone thinks is impossible, you are going to suffer before you succeed. The question is whether you have the financial resources and the psychological fortitude to endure that suffering. This is why I keep emphasizing cash reserves and reduced leverage. If the crash I am predicting takes 2 years to arrive, can you survive 2 years of waiting? Can you maintain your positions while everyone else is making money and telling you that you are wrong? Can you handle the emotional pressure of being contrarian? Most people cannot. That is why most people lose money when markets crash. Not because they did not see it coming. Many people see crashes coming, but because they cannot endure the waiting period, they capitulate. They abandon their positions. They give up just before being proven right. I want to talk more specifically about what sectors and asset classes I think are most vulnerable. Because not all parts of the market are equally at risk. Some areas are so overvalued, so over-leveraged, so dependent on low interest rates, that they could lose 70 or 80% of their value. Technology stocks, particularly artificial intelligence-related names, are in dangerous territory. Do not misunderstand me. AI is transformative technology. It will change the world, but transformative technology does not guarantee profitable investments. The internet changed the world too, and yet, investors who bought internet stocks in 1999 lost 80 or 90% of their money over the next few years. The companies building AI infrastructure, the chip makers, the cloud providers, the software companies, many of them are trading at valuations that assume everything goes perfectly for the next decade. No competition, no regulation, no economic downturn, no technological disruption. That is a lot of assumptions. When any of those assumptions prove wrong, the stocks will collapse. I have been short Nvidia and Palantir. These are incredible companies. But incredible companies at insane valuations become terrible investments. Nvidia is trading at multiples that assume their growth continues at current rates indefinitely. That has never happened in the history of the technology industry. Every company eventually sees its growth slow. Every hot sector eventually cools. The question is not whether, but when. Real estate, which I mentioned earlier, is another area of extreme vulnerability. Not just commercial real estate, which is already in crisis. Residential real estate is also at risk in many markets. Home prices have risen far faster than incomes. The only reason homes were affordable was because of low interest rates. With rates now much higher, affordability has collapsed. Either prices have to come down or rates have to come down. If rates stay elevated because of inflation, prices will fall significantly. Private equity and venture capital are sitting on enormous unrealized losses. During the zero interest rate era, these firms invested billions of dollars at valuations that only made sense if cheap money lasted forever. It did not. Many of their portfolio companies are now worth a fraction of what they paid, but they have not been forced to mark those losses yet because there is no liquid market for these investments. When they finally have to sell, when they need to return money to their investors, the marks will come crashing down. Cryptocurrencies remain a speculative bubble despite the recent price increases. I have been public about my views on Bitcoin and other cryptocurrencies. They are not currencies. They are not stores of value. They are speculative assets with no intrinsic value. The only reason they have any price at all is because people believe they can sell them to someone else at a higher price. That is the greater fool theory. And eventually, you run out of greater fools. The cryptocurrency market will crash along with everything else when risk appetite disappears. When people are worried about their jobs, their mortgages, their retirement accounts, they are not going to be buying speculative digital tokens. They are going to be selling them. And because the crypto market has even less liquidity than traditional markets, the crash will be even more severe. Now I want to address something important. The psychological traps that cause people to make terrible decisions during market crises. Because even if you understand everything I have told you, even if you agree with my analysis, you can still lose enormous amounts of money if you fall into these psychological traps. The first trap is denial. When prices start falling, most people convince themselves it is temporary. A correction, not a crash. They hold on, waiting for recovery. But sometimes recovery does not come. Sometimes the decline is just the beginning. People who bought tech stocks in March of 2000 thought the April decline was a buying opportunity. Then May was worse. Then June. Then a year later they had lost 80%. The second trap is anchoring. People anchor to the price they paid or the high watermark of their portfolio. They think, I will sell when I get back to even. But markets do not care what you paid. They do not care about your break-even point. They move based on supply and demand, fundamentals and sentiment. Waiting to get back to even can mean waiting forever. The third trap is social proof. When everyone around you is panicking, it feels right to panic too. When everyone is euphoric, it feels right to be euphoric. But the crowd is usually wrong at extremes. The time to buy is when everyone is telling you to sell. The time to sell is when everyone is telling you to buy. Going against the crowd feels terrible, but it is usually the right decision. The fourth trap is recency bias. People assume recent trends will continue forever. If stocks have gone up for 10 years, they assume stocks will keep going up. If interest rates have been low for a decade, they assume rates will stay low. But trends reverse. Conditions change. What worked yesterday might not work tomorrow. The fifth trap is overconfidence. After a long bull market, people think they are investment geniuses. They confuse luck with skill. They confuse a rising tide lifting all boats with their own brilliant stock picking. This overconfidence leads them to take excessive risk just before the crash, when they should be reducing risk. I have fallen into some of these traps myself. I am not immune to psychology just because I understand it. But awareness helps. Knowing these traps exist helps you recognize when you are falling into them. Let me share one more story that illustrates why timing is so difficult and why you need to be prepared for scenarios you cannot predict. In early 2008, after the first signs of trouble in the mortgage market, there was a period where things seemed to stabilize. Bear Stearns had collapsed in March, but the Federal Reserve had brokered a rescue. Markets rallied. People thought the worst was over. Experts declared that the system had been saved. Then came September. Lehman Brothers failed. AIG needed a bailout. The money market funds broke the buck. Credit markets froze completely. In a matter of weeks, the entire global financial system came within hours of complete collapse. Nobody predicted September. Nobody knew Lehman would fail. Nobody expected the chain reaction that followed. The people who had reduced risk earlier, who had built cash reserves, who had avoided over-leveraged positions, they survived. The people who had relaxed after the Bear Stearns rescue, who thought the worst was over, they were destroyed. The point is that you cannot predict exactly how a crisis unfolds. You can see the vulnerabilities building, you can identify the risks, but you cannot know which domino falls first or how fast the chain reaction spreads. That is why you have to be prepared in advance. You have to reduce risk before the crisis, not during it. Because once it starts, it will be too late. I have given you a lot of information today. Let me summarize the key points. First, the Federal Reserve is trapped. They cannot raise rates enough to kill inflation without crashing the economy. They cannot lower rates to support growth without reigniting inflation. Every option is bad. Second, valuations are at extreme levels. The Shiller PE, the Buffett indicator, multiple other metrics all say the same thing. The market is overvalued by any historical standard. Third, debt levels throughout the system are dangerous. Government debt, corporate debt, consumer debt, everyone is leveraged. There is no cushion. Fourth, the mechanisms that can accelerate a crash are in place. Algorithmic trading, passive investing, margin debt. These can turn a correction into a catastrophe. Fifth, inflation is likely to prove more persistent than expected. Tariffs, supply chains, labor markets, multiple forces are pushing prices higher. Sixth, when the Federal Reserve is eventually forced to raise rates significantly, the bubble will burst. It could happen next month. It could happen next year, but it will happen. My advice is simple. Reduce exposure to overvalued assets. Avoid long-duration bonds. Be cautious about real estate. Avoid leveraged and speculative investments. Maintain significant cash reserves. Prepare mentally for volatility, and position yourself to take advantage of the opportunity when it comes. The crash will create opportunities. Incredible companies will be available at incredible prices. Real estate will be cheap. Bonds will offer attractive yields. The investors who are prepared, who have capital to deploy, who have the courage to buy when others are selling, will make fortunes. That is how I made my fortune. Not by riding the bubble up, by seeing it for what it was, positioning against it, and then buying aggressively when it burst. I am positioning for the same opportunity now. The question is whether you will be positioned alongside me or whether you will be one of the people selling to me at the bottom. The choice is yours, but make it consciously. Make it with full understanding of the risks you are taking, and make it soon, because time is running out. The Federal Reserve rate hike that could crash the market is coming. Be ready. Let me tell you about what happened after I made my fortune from the housing crash, because it is relevant to understanding why I'm speaking out now. After closing Cyan Capital in 2008, I went through what I can only describe as a dark period. I had been vindicated. I had made hundreds of millions of dollars, but I was exhausted. The stress of fighting my investors for 2 years, of enduring constant criticism, of knowing what was coming while nobody believed me, it took a toll. The IRS audited me repeatedly. Not because I did anything wrong, but because making that much money from betting against the housing market drew attention. I faced lawsuits. I faced regulatory scrutiny. I faced skepticism from people who thought I had somehow cheated or gotten lucky. I stepped away from investing for years. I focused on personal investments, water rights, farmland, real assets that would have value regardless of what financial markets did. I needed a break from the madness. When I reopened Cyan Asset Management in 2013, I approached investing differently. I was more selective, more cautious, more focused on protecting capital than maximizing returns. I had learned that being right is not enough. You also have to survive the journey. Over the past decade, I have made mistakes. I have been early on predictions that have not yet materialized. I have faced criticism for being too bearish, too cautious, too focused on risks that have not yet crystallized. The perma-bear label has followed me everywhere. But I do not apologize for being cautious. I do not apologize for seeing risks that others ignore. Because when those risks finally materialize, and they always do, the cautious investors are the ones left standing. The aggressive investors, the ones who mocked the bears, the ones who said this time is different, they are the ones who lose everything. I have recently closed Cyan Asset Management again, not because I am wrong about the market, but because managing other people's money when your view is so different from consensus is exhausting. Investors want returns every quarter. They want to match the index. They do not want to hear about risks that might not materialize for years. And I cannot, in good conscience, manage money in a way that ignores the dangers I see. So I am doing what I did in 2005 and 2006. Speaking out, warning people, trying to help ordinary investors understand what is happening before it is too late. The difference this time is that I have no financial stake in being right. I am not short the market in any significant way. I am not going to make money if the crash happens. I am simply trying to help people avoid the devastation that I saw in 2008. The devastation that destroyed families, that wiped out retirement accounts, that caused suicides and divorces and bankruptcies. If I can help even a few people avoid that outcome, if I can convince even a few people to reduce their risk and protect their capital, then this effort will have been worth it. Let me address the skeptics one more time. The people who will say, I have been wrong before. Who will point to predictions I made that did not come true. Who will say, I am just trying to get attention or sell something. Yes, I have been wrong before. I have been early on predictions that have not yet materialized. The market has continued higher despite my warnings. People who ignored me have made money, at least on paper. But being early is not the same as being wrong. The housing market continued higher for 2 years after I started betting against it. People who ignored me made money during those 2 years. Then they lost everything. The people who listened to me, who reduced their risk, who avoided the most dangerous investments, they kept their wealth. The same pattern will repeat. The market can continue higher for months or years. People who ignore my warnings might make money in the short term. But eventually the fundamentals assert themselves. Eventually the bubble bursts. And when it does, the people who listened, who prepared, who protected their capital, they will be the winners. I do not care about being right in the short term. I care about being right over the full cycle. And over the full cycle, protecting capital during the bubble and having resources to deploy during the crash, that is what creates wealth. The final thing I want to say is this. I am not telling you what to do. I am not your financial advisor. I do not know your personal situation, your risk tolerance, your time horizon. What is right for me might be wrong for you. But I am telling you what I see. I am sharing my analysis. I am warning you about the risks that I believe exist. What you do with that information is up to you. My track record speaks for itself. I am the person who saw the 2008 crisis coming years before it happened. I am the person who bet against the housing market when everyone thought I was crazy. I am the person who made hundreds of millions of dollars when my analysis proved correct. Maybe I am wrong this time. Maybe the bull market continues forever. Maybe valuations no longer matter. Maybe the Federal Reserve has figured out how to prevent crashes permanently. Maybe this time really is different. But I do not think so. And based on everything I know, everything I have studied, everything I have experienced over 3 decades of investing, I believe the biggest crash of our lifetimes is coming. Prepare accordingly. Reduce risk, build reserves, protect your capital, and be ready. Because when the Federal Reserve rate hike that crashes the market finally arrives, you do not want to be caught unprepared. You want to be positioned to survive, and then to thrive. That is my message. That is my warning. The rest is up to you.